Welcome back to our channel, where we dive deep into the fascinating world of industry giants. Today, we're bringing you an exciting showdown between four major players in the consumer defensive sector: Colgate-Palmolive, Mondelez International, Unilever, and Walmart. We'll break down their key financial metrics, explain what each one means, and compare them head-to-head to see who comes out on top. Get ready for a roller coaster of insights and numbers that will keep you on the edge of your seat. First up, let's talk about the price-to-earnings ratio. This metric tells us how much investors are willing to pay today for a dollar of earnings from the past year. Leading the pack is Walmart with a P/TTM of 30.24, making it the most expensive relative to earnings. In contrast, Mondelez offers the lowest P/TTM at 19.72, suggesting it's seen as the most affordable. Looking at the P 5-year average, we see consistency across the board, but Walmart still holds the highest average at 24.24, while Unilever has a stable 19.49. Forward P shows potential future valuation, with Walmart at 26.39, indicating steady investor confidence, while Mondelez's 18.10 suggests a bargain for future growth. Moving on to the price-to-earnings growth ratio, which considers the PE ratio relative to growth. Mondelez shines here with a PG of 2.90, suggesting its high valuation considering its growth prospects despite being the lowest one between four of them. Unilever, with a PG of 4.18, appears pricier in terms of growth expectations, similar to Walmart with a value of 3.70. While Colgate-Palmolive's PG suggests a more reasonable price than the last two despite being also a too high value of 3.46. Next, let's consider insider ownership, which shows the percentage of shares held by insiders. Walmart tops the chart with a significant 46.38%, indicating strong confidence from within the company. In contrast, Unilever has 0%, showing less insider stake in the game, while Mondelez and Colgate indicate a typical value of the sector. Profitability metrics are crucial for understanding company efficiency. Return on equity showcases how effectively a company uses shareholders' equity to generate earnings. Colgate-Palmolive leads with an astonishing 2,331.25% due to its retained earnings, which makes the equity be lower than usual, demonstrating highly efficient use of equity. Unilever follows with 34.81%, while Mondelez has 15.13%, indicating room for improvement. Continuing with the return on assets, that follows a similar trend, with Colgate-Palmolive at 15.95%, showcasing asset efficiency, while the other three companies have a more modest value indicating that an improvement is necessary. Finally, return on invested capital highlights Colgate-Palmolive again at 38.27%, indicating excellent management of invested capital. Unilever at 19.34% and Walmart at 16.38% show good efficiency also. So in general, it's clear that Colgate has the most consistent ratios that is reflected in its price-to-earning ratio over the 5-year average, while Mondelez ones are lower, and this translates to a potential PE decrease. When it comes to the evolution of shares outstanding, Mondelez is decreasing shares at a compound annual growth rate of 2.43%, potentially increasing shareholder value. Colgate-Palmolive is also decreasing shares by 1.22% CAGR, while Walmart shows a decrease of 2.02% CAGR. This commitment by the four companies to buy back their own shares is a good sign, especially to Mondelez and Unilever because they did so at current prices and not at historical highs. However, for Walmart and Colgate that currently are at all-time highs can be a worse sign. And it is possible that this year and the next few years these buybacks decrease a little bit and use their free cash flow to repay the debt. Next, earnings per share or EPS is another key metric. Mondelez boasts a solid $3.37 EPS, leading the pack. Colgate-Palmolive and Unilever follow with $3.36 and $2.67, respectively. These numbers are not so high but consistent, and looking ahead, Colgate-Palmolive is expected to see a significant increase with a CAGR of 8.44% over the next 5 years, showing strong growth potential. Walmart follows the pack very closely with expected annual growth rate for the next 5 years of 8.17%, while the other two companies show more modest growth despite being considered good to the companies in this sector. The evolution of earnings per share over the last decade shows Mondelez leading with a 7.49% CAGR, indicating robust growth. In contrast, Colgate-Palmolive has struggled with a 1.53% CAGR, showing room for improvement. Next, let's talk about free cash flow per share. Unilever leads with an 11.34% CAGR in the last decade, highlighting strong cash flow growth. Walmart, however, has seen an upside of only 0.7% CAGR, raising potential concerns about cash flow management. For all you dividend lovers out there, starting with the highest dividend yield, Unilever offers a generous yield of 3.21% with quarterly payments between 45 cents and 48 cents. Additionally, over the last decade, its dividends have grown at a compound annual growth rate of 2.51%. Secondly, Mondelez provides a solid 2.71%, with a compound annual growth rate of 11.74% and a quarterly payment of 45 cents. In contrast, Colgate-Palmolive offers a 2.04% dividend yield with 50 cents quarterly payments and 3.42% dividend growth over the last 10 years, so we have less initial yield and less growth potential in this company. Finally, Walmart offers a dividend yield of 1.17% and a 2.37% compound annual growth rate. So it indicates less initial dividend yield and less growth. However, its large insider ownership, stable business model, and lower free cash flow yield can imply more dividend safety and sustainable growth potential. When we analyze one company, it is essential to take a look at its margins. In this case, the operating margin is like the pulse of a business. Colgate-Palmolive leads with 22.28%, indicating excellent operational efficiency. In contrast, Walmart's 4.2% shows a lower operating margin, but this is due to the condition of discount stores that usually have a value below 3, so this number is not bad at all. Profit margin follows a similar trend, with Colgate-Palmolive at 13.22%, showcasing high profitability. Walmart's 2.88% is respectable but not competitive in this group, despite being so competitive in the discount stores industry. The evolution of revenue and earnings over the last 8 years shows Walmart with a very positive evolution, reflected in its market performance. Mondelez also shows positive evolution, but with lower total returns to the VOO, S&P 500 ETF. However, Colgate-Palmolive and Unilever have shown flat evolution, resulting in lower market returns. Debt to EBITDA shows us how many years it would take for a company to pay off its debt using its earnings before interest, taxes, depreciation, and amortization. In simpler terms, it's like asking, how many years of my salary would it take to pay off my car loan? Walmart is the least leveraged with a ratio of 1.49, indicating lower debt levels relative to EBITDA. In contrast, Mondelez has higher debt levels, indicated by a ratio of 2.47. All four companies show excellent levels of debt compared to their respective EBITDAs. Next, we have debt/free cash flow. This one tells us how many years it would take to pay off debt using the company's free cash flow, which is the cash left after all expenses, investments, and dividends. It's like asking, how many years of my leftover money after bills and fun would it take to pay off my loan? Unilever has a ratio of 3.51, but Mondelez shows a higher value at 5.35, suggesting cash flow management concerns. The average price return of the last 52 weeks shows Walmart experiencing the highest return at 37.27%, followed by Colgate-Palmolive at 28.34%. Unilever has a return of 9.86%, while Mondelez shows a decline of -9.23%. Despite these variations, all four companies have strong market positions with market capitalizations over $80 billion. Finally, analysts predict that in the next 12 months, Colgate-Palmolive's price could hit $101.54, representing an upside of 3.53% from its current price of $98.08. But hold your horses. Personally, I believe the fair value is around $75.03 after adding a margin of safety of 15%, suggesting it might be overvalued at the moment. Also for Mondelez, analysts predict an upside of 18.96% from the current price of $66.45 to $79.05, but for me a reasonable price would be around $68 after adding a margin of safety of 15%. Indicating potential undervaluation and an excellent opportunity to add this company to our portfolios. For Unilever, analysts predict a downside of 17.23% from the current price of $58.03 to $48.03, and for me a reasonable price would be around $62.37 after adding a margin of safety of 15%, suggesting potential undervaluation. Finally, for Walmart, analysts predict a slight upside of 2.61% from the current price of $70.75 to $72.60, and for me a reasonable price would be around $51.33 after adding a margin of safety of 15%, indicating potential overvaluation. And there you have it, folks. An in-depth, head-to-head comparison of Colgate-Palmolive, Mondelez International, Unilever, and Walmart Incorporated. Each company has its strengths and weaknesses, and now you're armed with the knowledge to make an informed decision. Which consumer defensive giant caught your eye? Let us know in the comments below. If I had to choose a company from these four, I would choose Mondelez, although I consider that there are companies in this sector that currently have a better valuation and greater growth potential, such as Diageo, PepsiCo, or Hershey. Finally, if you found this video insightful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Until next time, keep investing wisely.